Do the markets give us any clue as to whether we're at the risk of a larger banking crisis?
Well, there certainly seems to be that risk out there, right, Jake? And I think the reality is we just simply don't know. The big banks for sure are well capitalized, but take a look at some of the regional banks, some of the smaller, medium-sized banks. And Jake, you can see a real sort of jitteriness among investors. I mean, First Republic closing down about 62%. Zions, we just lost it there, but PacWest 21%. Jake, these are not movements that we tend to see in stocks. These are really dramatic falls. And so the concern with some of these regional banks is that they could perhaps be facing some of the same risk factors that ultimately brought down SVB in terms of sitting on customer deposits that aren't fully insured by the FDIC, and also the interest rate risk that we know was at the heart of SVB's failure. Now, at the same time, Jake, I want to point your attention to the broader markets. The Nasdaq actually closed up. The S&P was up about 5 minutes before we closed and closed lower fractionally. And the reason why is because all of this news that we're getting about the fragility perhaps of the banking market, making some investors feel like, well, maybe this will help the Fed cool it on the rate hikes. And we hear from the Fed next week, so a lot more to come there, Jake.
All right, interesting. Rahel Solomon, thanks so much. President Biden said that customers and small businesses who had money in those two banks should be able to access their money today. But he also said investors in those two banks will not be protected. They will likely lose their money. President Biden also blamed this banking crisis on a move by his predecessor, Donald Trump, to loosen requirements of those banks. We asked CNN's Phil Mattingly to bring us the facts on all of this.
The bottom line is this. Americans can rest assured that our banking system is safe.
President Biden seeking to reassure a nation on edge.
During the Obama-Biden administration, we put in place tough requirements on banks like Silicon Valley Bank and Signature Bank.
He also placed blame on his predecessor for contributing to this moment.
Unfortunately, the last administration rolled back some of these requirements.
Biden pointing to a 2018 law that eased some of the strictest post-financial crisis restrictions on mid-sized lenders like Silicon Valley Bank.
I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again.
Biden's new regulatory push framing a new crisis moment.
Treasury Secretary Yellen and a team of banking regulators have taken action.
Just hours after the administration's top finance officials triggered a dramatic show of dual-pronged government force. The action designed to halt financial contagion that threatened to rip through the banking system after the failure of Silicon Valley Bank. The bank's failure on Friday risking a cascade of events that threatened financial stability, with a second bank failure Sunday and several more institutions on the brink, officials said.
When we learned of the problems of the banks and the impact they could have on jobs of small businesses and banking system overall, I instructed my team to act quickly to protect these interests.
93% of Silicon Valley Bank's deposits sat above the $250,000 deposit insurance limit.
I've been working all weekend with our banking regulators to design appropriate policies to address this situation,
leaving thousands of small businesses and individuals at risk.
I instructed my team to act quickly to protect these interests. They've done that.
But the speed of the crisis and the potential systemic effects marking a jarring turn for an industry viewed as stable and well capitalized.
There are important questions of how these banks got into the circumstance in the first place. We must get the full accounting of what happened and why those responsible can be held accountable.
And setting the stage for an equally unpredictable political fallout in the days ahead, as officials move quickly to try and separate their actions from the politically toxic bailouts of the 2008 financial crisis.
No losses will be, and this is an important point, no losses will be borne by the taxpayers.
And Jake, Rahel was pointing to those regional banks and what's happened to them in the equity markets. They're not the only ones that are watching those banks right now. The White House, the Treasury Department, also paying very close attention to mid-size and small lenders, trying to ensure that there is no contagion. One thing to pay attention to, though, when you talk to officials, they make clear, yes, they see what's happening in the stock market, but there's also the issue of liquidity. They believe that these banks have had access to liquidity in large part, because of the efforts over the weekend. They believe that is a positive sign, but still, obviously, a bumpy road ahead, Jake.
All right, Phil Mattingly at the White House for us. Thanks so much. Let's bring in Mark Zandi, the chief economist of Moody's Analytics. Mark, you just heard President Biden blaming these failures in part on Donald Trump for rolling back financial regulations in 2018. Is that an accurate claim? Is that part of what went wrong here?
Well, Jake, it certainly didn't help. I mean, I think if Silicon Valley Bank had taken the stress tests like the larger banks had done, that they may have uncovered the kind of fault lines in the bank and some of the problems that the bank are facing. Not a guarantee. I mean, these are only simulations. You test the bank under different scenarios, so who knows? But certainly didn't help.
Should Americans across the country watching us right now be worried about their money?
No, I don't. No, obviously not. Not at this point. I mean, the president has come in and said, "Look, what's happened here is a systemic problem to the entire banking system. So if you're a depositor in the bank, whether it's below 250K in deposits or above 250K in deposits, your money good. You're going to get your money out at this point in time. So I don't think there's anything to worry about here at all.
What's the difference between the big bank bailouts we saw in 2008 and what the government's doing now?
Well, one thing is just scale. I mean, what we're talking about here is a few banks that got into trouble. And back in the financial crisis, it was nearly every bank that got into trouble. Not only here in the United States, but all over the globe. And it wasn't a few $100 billion at risk. It was trillions of dollars at risk. So the scale here is very, very different. No comparison.
So it was Silicon Valley Bank, then Signature Bank last night. Do you expect any other banks to be shut down or to collapse?
Hard to know. I mean, I don't know for sure. I doubt it, though. Certainly no big, large institutions. I don't think that's going to happen. These banks were very idiosyncratic. They were connected closely to the boom and bust in the tech sector and in the crypto markets that suffered a big crash not long ago. Very, very different kind of banks. Their deposit base is very different than the deposit base of most banks and financial institutions. So, no, of course, we're in a world of high interest rates and rising interest rates, so that does put pressure on the financial system, which by the way is by design. The Federal Reserve is trying to slow things down, but those rate hikes are putting pressure on the system, and when you're in that kind of environment, things can happen. But I don't think this is going to spread anywhere. Certainly not at this point, given all the things that the administration, the Federal Reserve, and the Treasury has done.
All right, Mark Zandi, thank you so much for your insights. Appreciate it. Here to discuss, Democratic Congressman Josh Gottheimer of New Jersey, who's on the House Financial Services Committee. Congressman, thanks for joining us today. Former ambassador and Republican presidential hopeful Nikki Haley tweeted, quote, "Joe Biden is pretending this isn't a bailout. It is. Now depositors at healthy banks are forced to subsidize Silicon Valley Bank's mismanagement. When the deposit insurance fund runs dry, all bank customers are on the hook. That's a public bailout. Depositors should be paid by selling off Silicon Valley Bank's assets, not by the public," unquote. Does Ambassador Haley have a point? Is this a bailout in a way?
This is about, I disagree. I mean, this is about protecting depositors at banks across the country. And of course, it starts with, it's a systemic issue, as the Fed and Treasury pointed out. If we let depositors feel across the country in small and medium-sized banks, small businesses, regular hardworking folks feel that they can't trust the money they're putting in their banks, their local banks, then the whole system will fail. And frankly, Jake, that's exactly what I'm worried about here. And I heard this from a lot of our smaller and regional banks today, that people are going and pulling their money out because they're worried their deposits won't be there when they need to go get them, when they need to go make payroll, when they need to pay their bills. And you can't have a system that we go back to 2008, 2009, pre-Dodd-Frank, where you have a few banks with all the concentrated dollars in the country and the regional and small and medium-sized banks dying. You go from a system that's too big to fail to a system where you've got small banks that are too small to survive, and we've got a real problem in this country.
So today, President Biden placed some of the blame on this move by President Trump and Republicans in Congress to roll back some of the financial regulations in 2018. I think it was some of the Dodd-Frank regulations. You just heard Mark Zandi say that change, that weakening of the financial regulations didn't help what happened in the last few days. I should note, you joined Republicans in passing that bill. Do you regret it?
No, for the same reason that you had a set of rules that literally applied to the largest few institutions in the country and also to our small, medium-sized, and regional banks it was impossible. They were all actually merging and selling to the larger banks, and you had no community banks left in this country. And you need good community healthy banks for local businesses and for families and for farms. You need that. It's really important. What happened in the Silicon Bank situation was their investments weren't smart, right? So they had put a ton of their money. They had plenty of their balance sheet was strong. The ratios, my understanding is the ratios from their holdings were strong. The issue is they'd put so much of their money that had been deposited into longer term treasuries. And as interest rates went up, of course, the value of those treasuries went down. And then when this was just a classic run on the bank, everybody wanted their money out in a few hours. There just wasn't money there to give because they wanted their money out so fast. So the FDIC and the OCC and other regulators, in my opinion, should have caught that. They should have said, wait a second, the asset mix here doesn't make sense. It's at risk. And obviously they were concentrated in a few industries like tech, which have faced some headwinds. So to me, this was just a matter of we should have had regulators on top of that.